Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to the Trading with Venus podcast. I'm your host, Raman Gill. Today we'll talk about a topic that I get asked about a lot, and that is how to pick the right broker. Now, there are a lot of different things that go into picking a right broker, and you have to make your own decision. You have to find somebody that fits your needs. So I do recommend that you do your research online, you check them out, look at their reviews and so forth. But here are my thoughts around picking the right broker. First of all, you want to work with a broker that does not trade against their clients. A lot of brokers will have their own trading desk as well as they take orders from the clients. So when a client places an order, they do not pass that order on to an external agency. They actually keep the order in-house and they take the opposite position of that. Basically, they are selling you something and you are on the buy side, so they are on the sell side, or vice versa. So the order stays in-house. When you close out the position, then their position gets closed as well. So either you are making money or they are making money. There is no win-win in this. It's either one person makes the money or another person makes the money. And the problem that can arise with this one is that they can then open up spreads because they have full control of the back end. They have the option of opening up spreads. So sometimes you may see the spread that's supposed to be 2 pips can be 20 pips. And if you are in the margin trouble, they can just as easily open up the spread and take you out from that over leveraged position. So it's very important to find somebody that is not biased in that sense, where it's a win-lose situation. So you want to find somebody that will not take the opposite side of your position, and they're looking to make money from the fees and commissions that they charge. Now, what can you do about it? What you can do is look for what's called an ECN broker. ECN brokers will actually not take the position on the opposite side of their clients. Instead, they get an external feed, and all the orders that are placed with them are then matched with these external orders, and then they just push the orders out. So they don't really have any kind of bias whether you win the position or lose the position, because it does not impact them at all. All the positions are just bundled up together and they are shipped out externally to what's called market makers. So market makers are the ones that will provide the feed that the ECN brokers will use, and they don't actually trade. They make their money from commissions, from the fees that they collect, any interest rate swaps, and so forth. So all their business comes from just the trading activity as opposed to trading in the opposite direction of their clients. So it's better to find somebody who is an ECN broker. Even with them, even they have an ability to open up spreads. So during times of low liquidity or when the markets are volatile, most brokers will have larger spreads. So make sure you keep that in mind as well. So check out the reviews of how people have experienced these type of conditions with these brokers. So very important to check that out. But between broker that will take a position in the opposite direction of you versus somebody who has an ECN feed, it's better to go with somebody who has an ECN feed. Another thing you want to look at is where is the broker regulated, or if they are regulated. So first of all, it's always best to go with a broker that is regulated. Regulated brokers have to follow certain rules depending on which country they are regulated in. So if somebody's regulated in Australia, for example, they have to follow the securities rules that are based in Australia or according to Australian law. When looking for a broker, you want to go to their website and make sure it says that they're regulated, and then look at where they're regulated. Look at where they're regulated is because it's better to go with brokers that are regulated in the countries that are a bit more stringent. This way, you will not be defrauded. The brokers have to follow those securities rules, and they will keep things within those rules. There's more oversight. These people are audited, and they have to provide audited documents and statements that the Security Council will look at. So always better to go with a regulated broker, because then they will hopefully not do any underhanded stuff. So this is another way to protect yourself. And next thing is where they're regulated. So if you are working with somebody who's regulated in US, Canada, for example, they have to follow more stringent rules. So the leverage will not be as high, which means you have to deposit more money in order to trade. When working with a broker that is regulated in your own country where you are from, the benefit of that is that usually there is an insurance that will cover you. For example, in Canada, if you are working with a broker who is regulated in Canada, certain amount of your money is protected. So if the broker were to go under, they declare bankruptcy, certain amount of your money is covered. So $100,000 up to $1 million of your money will be protected. So this is not you being in trades. They do not protect any profit or loss from the trades. Instead, this is the money that is in your account. So if broker goes bust and they just close shop, then the insurance policy will cover that money up to $100,000, and you will get the money back. So that is a benefit. The downside though is that you have lower leverage, so you have to deposit more money in your account in order to trade larger size. Now leverage is a dual-edged sword. Higher the leverage, you can take larger positions, but if the position goes against you, this is also one of the best ways to blow up your account. And a lot of us have been there. So leverage has to be used very, very carefully. I would rather recommend erring on the side of lower leverage. So brokers that give you 1000% leverage, in my opinion, is not a good idea, because they are just basically pushing people towards blowing their accounts. Now, again, it is not the broker's fault. You have to make your own decision. Do you want 1000% leverage? Because when you have that amount of leverage, it's easy to use it, because if you are in a position where you're stuck on the wrong side of a position, it is so easy to just take another lot size and just add to your position, and it never really ends well. So my recommendation is to really look at that leverage, and maybe if you do not want 50 to 1 leverage, you can maybe go to 100 to 1 or 200 to 1, but 1000 to 1, in my opinion, that is way too much, and you never want to really trade a full lot size with a $50 account. There's really no win situation there. It does not work over the long term. So you want your leverage to be reasonable so that you can make money. You can use other people's money to make money, which is what leverage is really about, but you're not blowing up your account by going overboard. Another thing that I find happens a lot in our business is brokers offering bonuses. Now, we may think that it's a great idea. If we deposit $100, we'll get a matching $100 or a certain amount of matched bonus. Although this looks good in theory, this is really not the best way to go. And the reason for that is that those brokers will not let you withdraw the money. They will force you to use that money, and really all they're really trying to do is want you to do that high turnover. So you are putting in a lot of trades and you're incurring a lot of fees and commissions, which then allow the broker to make the money. They force you to stay in the trades for a certain amount of time, or you have to be with them for a certain amount of time, and you have to have a certain amount of trades that need to happen, and they will have restrictions on when that money can be withdrawn. Even the money that you put in, they may not let you withdraw that money either. So always read the fine print, and the best practice really is to just stay away from brokers that offer bonuses, because I have never seen this to really work out well for anyone. So those are some of my thoughts on how to choose the right broker. Again, like I said in the beginning, it is a very important decision that you make. So if you are with a new broker, just start with a smaller amount of money. test them out, see how it goes before you really go to a bigger account size. And also make sure you check out the reviews, make sure what kind of problems they have experienced in the past, and how have they handled customer complaints, because that will provide you insight into what kind of a broker it is. So I hope you found this episode helpful. For show notes for this episode, please visit tradingwithvenus.com/podcast page. That's it for today. Have a great trading week, and I'll see you next time.
Thanks for joining us today. With much gratitude, your show host, Raman Gill.